Hey there, everyone. Welcome back to our channel. Whether you're a high school senior weighing your college options or someone already deep into their degree, we know that student loans can feel like a daunting topic. Today, we're diving into something that affects millions of students: how student loan interest works. So, if you've ever wondered how that interest adds up on your loans or how it impacts your total repayment, you're in the right place. But first, have you ever asked yourself, what exactly is student loan interest and how does it really work? Let's break it down. To start, let's clarify what interest actually is. In simple terms, interest is the cost of borrowing money. When you take out a student loan, the lender, usually the government or a private bank, charges you interest as a fee for allowing you to borrow the funds needed for your education. Now, there are two main types of student loans: federal and private. Federal loans often come with fixed interest rates, meaning the rate remains the same throughout the life of the loan. For example, as of 2023, the interest rate for subsidized and unsubsidized federal undergraduate loans is 4.99%. This means if you borrow $10,000 for your education, you'll pay back that amount plus the interest over time. Let's crunch some numbers. If you take out a $10,000 loan at a 4.99% interest rate and plan to pay it back over 10 years, your monthly payment would be around $106.
But by the end of the term, you'd have paid approximately $2,400 in interest. That's a significant chunk of change, right?
Now, let's talk about how interest accrues. For most student loans, interest begins accruing as soon as you take out the loan. However, with subsidized federal loans, the government covers your interest while you're in school, provided you're at least a half-time student. This means you won't pay any interest until after you graduate, which is a significant benefit. On the other hand, with unsubsidized loans, the interest starts accruing immediately. So, if you take out a $10,000 unsubsidized loan during your first year of college and only pay the minimum during school, you could see your balance grow significantly by the time you graduate. For example, after 4 years, that $10,000 could balloon to over $12,000 thanks to the interest that kept adding up. Another important concept is capitalization. This occurs when unpaid interest is added to your principal balance. For instance, let's say you have an unsubsidized loan and you don't make any payments while in school. When you graduate, your new loan balance will include the original amount plus the accrued interest. This can make paying off your loan even more challenging down the line. Understanding your loan terms is crucial. Here are a few key terms to remember. Principal, the original amount you borrowed. Interest rate, the percentage charged on the principal. Accrual, the process of accumulating interest on the loan. Capitalization, when interest is added to the principal balance. Now, how can you manage this interest and reduce the overall cost of your loans? Here are a few tips. Make payments while in school if you can. Even small payments can help keep your interest from accumulating. Explore income-driven repayment plans after graduation. These can lower your monthly payments based on your income. Look for loan forgiveness programs if you're working in public service or teaching. In summary, student loan interest can feel overwhelming, but understanding how it works is the first step in managing it effectively. By knowing your loan types, how interest accrues, and the importance of making timely payments, you can take control of your financial future. If you found this video helpful, please give it a thumbs up, subscribe, and hit that notification bell so you don't miss our future tips on managing your finances. And remember, knowledge is power, especially when it comes to your education and financial decisions. Thanks for watching, and see you next time.